Warren Buffett has a famous saying, "If you don't find a way to make money while you sleep, you will work until you die." Earning passive income is key to building a wealthy life and is right at the heart of why dividends can be such a powerful tool to help you achieve financial freedom. For example, did you know that the S&P 500 companies paid out $565 billion in dividends to their shareholders in 2022, despite the index suffering its worst annual loss since 2008? So how can you tap into this huge market and start living off dividends? In this video, we'll share with you 3 powerful strategies you can follow to use this remarkable money-making tool to earn passive income, even as you sleep. Make sure to stay with us, as at the end we'll show you the quickest way for you to live off dividends that you might not have heard of before. Whether you're joining us for the first time or you're a returning viewer, get ready for some practical advice on building wealth through dividends. Our aim is to demystify the process and show you a path to making your money work for you. But first, what are dividends? Dividends are a way for companies to share their profits with their owners. When you buy stock in a company, you own a piece of the company and become a shareholder. When a company makes profits, it can decide to give some of that money back to its shareholders, and that distribution of profits is called a dividend. Depending on which company's stock you own, dividends can be paid annually, quarterly, or even monthly. It's money that comes in while you're sleeping, eating, or enjoying your hobbies. Living off dividends means you've invested in enough companies that regularly distribute cash to its shareholders like you, such that the money they give back covers your needs. Pretty awesome, right? This doesn't happen overnight. It requires saving money, choosing the right companies to invest in, being patient, letting your investments grow over time, and having a strong portfolio. Building a strong portfolio is similar to creating a solid foundation for your financial future, especially if you're aiming to live off dividends. A key Buffett quote to remember is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This means focusing on quality over just getting a cheap deal. Not all companies pay dividends, so when selecting dividend stocks, look for companies known for their stability and consistent dividend payments. These companies are often in established industries and have a history of making profits and sharing them with shareholders. The best dividend stocks are shares of well-established companies that increase their payouts over time. This is measured by something called the dividend yield. The dividend yield is the percentage of money a company pays shareholders for owning a share of its stock divided by its current stock price. As a rule of thumb, dividend yields of between 2% and 5% are considered strong, and anything above this can be a good buy, but may also come with risks attached. What strategies can you follow to live off dividends? Strategy 1. Blue chip dividend stocks. Blue chip stocks are shares in large, well-established companies known for their reliability and financial stability. These companies often have a long track record of success and are leaders in their industries. Warren Buffett once said, "Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years." This quote emphasizes the importance of choosing investments that are not only good for today, but will also stand the test of time. Blue chip dividend stocks fit this bill because they are often less risky and provide consistent dividend payments. Investing in these stocks is similar to building a strong foundation. These companies are usually less affected by market fluctuations, making them a safer bet for long-term investment. They generate steady income through dividends, which can be reinvested to buy more shares or used as part of your living expenses. The key to success with blue chip dividend stocks is patience. It involves playing the long game, focusing on steady growth rather than quick wins. Over time, the dividends from these stocks can compound, leading to significant growth in your investment. When selecting blue chip dividend stocks, look for companies with a strong history of dividend payments, healthy balance sheets, and a competitive edge in their industry. These factors suggest that the company is well managed and likely to continue thriving. Great examples include AT&T Inc., which was one of the original blue chips. AT&T provides telecommunications, media content, mobile phone service, and technology to individuals and institutions globally, and has a 12-month dividend yield of 6.8%. PepsiCo is another great example. It currently has very strong cash flow, earnings stability, and a strong balance sheet, all of which mean a 12-month dividend yield of 3%. Strategy 2. Dividend growth stocks. These are shares in companies that pay dividends and increase their dividend payments over time. Dividend growth stocks are attractive because they offer the potential for both income through dividends and capital appreciation as the value of the stocks increases. This combination can be powerful for building wealth over time. Companies that can consistently increase their dividends are often well-managed, financially stable, and capable of generating steady growth. Investing in dividend growth stocks means looking for companies with a proven track record of increasing their dividends year after year. As dividends increase, you can reinvest them to buy more shares, which in turn will generate more dividends. Over time, this can lead to exponential growth in your income from dividends, potentially reaching a point where it can cover your living expenses. It's important to be selective when choosing dividend growth stocks. Look for companies with sustainable business models, a competitive edge in their industry, and a clear commitment to returning value to shareholders through dividends. Great examples include Accenture, the global professional services company that has a 3-year dividend growth rate of 24.6%. Target Corporation is another excellent dividend growth stock. The retail chain company has raised its dividends for the past 52 consecutive years, and its 3-year annual average dividend growth rate is 29 to 66%. Strategy 3. Covered Call ETFs. Covered call ETFs offer the quickest way to build your dividend income, although they do come with some additional risk when compared to blue chip or growth stocks. They are a particularly popular strategy when the objective is for regular dividend income rather than strong appreciation of the underlying stocks. Firstly, let's cover the basics. Exchange-traded funds, or ETFs, invest in a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index like S&P 500. Unlike index funds, you can buy and sell ETF shares just like individual stocks during the trading day, which makes ETFs very flexible. So, what are covered call ETFs? Covered call ETFs are special types of funds that combine stocks and options. They own a portfolio of dividend-paying stocks while at the same time selling or writing covered call options on those same stocks to generate extra income. That's great, but what's a call option, I hear you ask? Call options are financial contracts that give the buyer the right, if they so choose, to buy a stock at a specified price, the strike price, within a specified period. For covered calls, the ETF purchases shares in a business and sells call options for those shares. The ETF earns a premium when selling the option and owns the underlying shares unless the option is exercised and they are sold. These ETFs aim to provide income through dividends from the stocks they hold and the premiums from the call options they sell, which can be higher than traditional dividend-paying stocks alone. This provides investors with a steady income stream from their investments while providing them with some protection from risk, as decreases in the fund's holdings can be offset by the premiums that the fund earns from selling options. Examples of covered call ETFs in the market include XWild, the S&P 500 covered call ETF, which has a 12-month dividend yield of 11.54%, or QILD, the Nasdaq 100 covered call ETF, which has a 12-month dividend yield of 13.48%, and TLTW, the iShares 20-year Treasury Bond Buy Right Strategy ETF, which has a 12-month yield of 17.9%. Covered call ETFs can be particularly appealing for those seeking to live off dividends because they tend to offer higher income potential than traditional dividend stocks. However, it's important to remember that the trade-off for this higher income can be limited capital appreciation, as the upside of the stock is capped by the call option. In other words, if the stock price increases significantly, the owner of the call option is more likely to exercise their option, and the ETF will have to sell those shares at the pre-agreed strike price. This means the ETF forgoes any capital appreciation above the strike price, putting a ceiling on the gains that can be earned from covered call ETFs. As a result, covered call ETFs can be particularly attractive when investors expect the stock market to be flat or declining, as the option is less likely to be exercised during these periods while still providing a steady and high income. So here's an example of how you can utilize covered call ETFs to make $3,000 a month. If a covered call ETF offers a 12% annual yield, it means for every $100 you invest, you can expect to earn $12 over a year. If your goal is to earn $3,000 each month, then you need to earn $36,000 a year. Now, if a covered call ETF yields 12% per year, you can work out how much you need to invest to get $36,000. You do this by dividing your annual income requirement by the yield rate. So, $36,000 divided by 12% equals $300,000. This means to earn $3,000 a month from an ETF with a 12% annual yield, you would need to invest $300,000. While that might seem like a large investment, the higher the dividend yield, the lower the investment required. For example, if you invested in the TLTW, which pays a dividend yield of 17.9%, the total investment needed to earn $3,000 a month drops to $201,000. A covered call ETF paying a higher yield than 17.9% would drop the required investment even further, although does come with additional risks. So, let's compare the covered call ETF to the traditional dividend investment method. With traditional dividend investing, you're buying shares in companies that pay a portion of their profits back to shareholders as dividends. Imagine a company that pays a 3% dividend yield, which is fairly common. To make $3,000 a month, or $36,000 a year, with a 3% dividend yield, that is for the traditional dividend method, you'd need a much larger investment compared to covered call ETFs. Here's the math. Annual income needed: $36,000. Dividend yield 3%. Total investment required: $36,000 divided by 3% equals $1.2 million. So with a 3% dividend yield, you'd need to invest $1.2 million to achieve a $3,000 monthly income. That's $900K more than if you invested in covered call ETFs with a 12% yield, which, as we saw earlier, would require an investment of $300,000. This comparison highlights the main advantage of covered call ETFs: the potential for higher income with a smaller investment, thanks to the additional income from sold call options. That's not to say you should go all in on covered call ETFs. Both methods have their place in an investment strategy depending on your goals, risk tolerance, and investment horizon. Traditional dividend investing is typically seen as more conservative, focusing on steady income and long-term capital appreciation. Covered call ETFs, meanwhile, can provide higher income in the short term, but with different risks and trade-offs. It's also important to remember that investing involves risks, and yields can change based on market conditions. Plus, there are taxes and fees to consider which might affect your actual returns. To make the optimal dividend investing strategy, I recommend your portfolio has a high level of diversification. An example portfolio might be to invest 50% of your capital in blue chips, 30% in growth stocks, and 20% in covered call ETFs. That way, you can tap into the high income potential of covered call ETFs, particularly when the market is flat or declining, while managing the extra risk associated with them by also investing in blue chips and growth stocks, which allow you to still benefit from capital appreciation when markets are rising. Whatever strategy you decide to take, you should always consult a financial advisor to make sure you find the approach that is best tailored to your financial goals and attitude to risk. Having a long-term perspective is crucial. Building wealth through dividends isn't about getting rich quick. It's about patience, consistency, and steady growth. If you found value in this video, please hit the like button. Don't forget to subscribe and click the bell icon so you won't miss out on more content. Until next time, keep working on building your wealthy life.